Hey, welcome along to Whiteboard Fridays. So we're trying something new, see if you like it. I'm Jeff, and today I'm going to be talking about a comprehensive capital income tax. You might be thinking, what the hell is that? Well, that's what this video is all about, to explain what that is. Firstly, what is capital? Well, some people call it assets, wealth, capital. It's all the stuff that earns you income or generates you benefits without you having to do anything, okay? So all of the machines, assets, stuff in your life that does things for you without you having to do it yourself with your own bare hands. So that's what capital is. And the idea of a comprehensive capital income tax is to tax all of the income from capital evenly. Now, we don't do that at the moment. If you think about it, bank accounts, do we tax those? Hell yeah, you see that taken out every time you get an interest payment. Kiwi saver, have a look at your statement. You get taxed on any benefits, any income you get from Kiwi saver too. Shares, yes, your dividends count as income. Now we start to get to things that aren't taxed as evenly. Lifestyle businesses can hide lots of costs in the lifestyle business so they don't pay much tax. And of course, property, the income from property isn't taxed either. Now what do I mean by that? Well, you get some benefits from having a lifestyle business or from property that aren't taxed because they're non-cash benefits. So for example, if you have a bunch of money, you've got a choice. You could either put it in the bank, right? In which case you get paid the interest and you pay tax on that interest, okay? And you might use the money from that to, say, rent a house. Whereas if you were to buy a house straight off, then you don't have to pay rent because you own the house. You're effectively paying rent to yourself. And because no money is changing hands, you don't have to pay any tax on that. So you're much better off from a tax efficiency perspective buying a house than you are sticking the money in the bank. And you wonder why so many people in New Zealand are desperate to buy houses. It's because we don't tax these things evenly. So that's the problem. And actually it's a $7 billion problem because that is the gap in the government's revenue that we would have if we taxed all capital the same as we tax bank accounts. It's a lot of money. You could use that in a bunch of ways. You could improve health. You could give everyone an unconditional basic income. You could even drop other tax rates down to make them lower. Now, what do you need to do? How to do a comprehensive capital income tax? Well, you need to know two things. First, you need to know the risk-free rate of return. And that basically means how much can you get if you just stick your money in a no-risk bank deposit, something like a long-term government bond, okay? And at the moment, that is about 5%. So this is important because if you've got money in a lifestyle business or in property and you're not getting any cash from that, then why the hell wouldn't you put it into something that's earning 5%? Well, the answer is that you are getting benefits from it, okay? It's just because no cash is changing hands that you are not paying tax on that. So, you work out the risk-free rate of return, which is 5%. That's what you should be earning on the money that you've got invested in property or lifestyle businesses. And we assume that that is the benefit that you are getting from the money that you've invested in these things. And then we tax it according at that rate. So let's say you've got a tax rate. If we had a comprehensive capital income tax, we'd have lower tax rates. So say you've got a tax rate of about 25%. So the money you've got invested in a lifestyle business or property, we assume it's generating a 5% return, and then we tax that return at 25%. So for example, if you've got $500,000 invested in a lifestyle business or a property. We assume a risk-free rate of return of 5%, which is $25,000. And we would tax that at 25%, so a quarter of 25,000, $6,000. So that's roughly the tax that you would pay under a comprehensive capital income tax for investing that amount of money in something like property or a lifestyle business. Now, if your investment is already generating the risk-free rate of return or above, more than the 5%, which all of these things would be, then there's no tax to pay, no extra additional tax to pay. This isn't about taxing all wealth or assets. It's about taxing the ones that we don't tax at the moment. If we treated these the same as these other assets, then there'd be much more of an incentive to invest in these things, rather than at the moment we have a huge incentive to invest in lifestyle businesses and property because they're not treated the same from a tax perspective. That's why you have a housing boom, that's why you have high house prices, and that's why you have people spending millions of dollars on batches in the Coromandel Peninsula to avoid tax. A comprehensive capital income tax would change all that. So that was our first whiteboard session. My name's Jeff, thanks for joining us. If you have anything that you'd like covered in any of these sessions, get in touch. Put it on a comment below. Any other questions you want us to follow up? What was this like? Was it too damn confusing? Was I talking too fast? Do you not like my shirt? Say it all.